Chile, 1981. A military dictatorship redesigned the entire national pension system. Every civilian worker was forced into private individual accounts managed by for-profit companies. Economists called it genius. The World Bank endorsed it. Milton Friedman's disciples designed it. But here's the detail they don't teach you in economics class. The military exempted themselves. They kept their own generous, taxpayer-funded, state-guaranteed pensions through a separate system called Capredena, and forced everyone else into the experiment. 40 years later, the median Chilean retiree gets 17% of their working salary from those private accounts. 80% of pensioners live below minimum wage. The architects knew, they just didn't care. But Chile isn't the real story. Chile is just one chapter in a $65 trillion global failure. And your country is in this book too. Because the pension promise made to every worker on Earth is mathematically broken. The Netherlands, ranked the #1 pension system on the planet 4 years running, score 84.8, just voluntarily gutted its own pension guarantees, converted €1.5 trillion in promises into market bets. The United Kingdom's pension funds came within hours of total collapse on September 27, 2022. The Bank of England worked through the night. Japan's fertility rate hit 1.15 in 2024, a record low 15 years ahead of worst-case projections. Only 686,000 babies born, fewest since records began in 1899. And US state and local pensions? Somewhere between $1.3 and $5.1 trillion short, depending on who's doing the math. Whether you call it a pension, a 401k, a superannuation account, or a provident fund, the math is the same. Every system on Earth uses some combination of 3 models we're about to break down, and all 3 are failing. The average future retiree in developed nations is projected to receive just 63% of their pre-retirement income. That's a 37% pay cut the day you stop working. If your retirement math never quite added up, you weren't imagining it. If you're between 25 and 55, the pension system you're paying into right now was designed for a world that no longer exists. To understand how we got here, you need to understand that humanity has tried exactly 3 ways to pay for old age, and all 3 are now failing. Every pension system on Earth is built on one of 3 blueprints. All 3 were designed by men who assumed the future would look like the present. It didn't. Model 1. Bismarck, 1889, Germany. Pay as you go. Otto von Bismarck invented the state pension, not out of compassion, but to undercut socialist revolutionaries. The deal was elegant in its simplicity. Today's workers pay for today's retirees. Germany, France, Italy, Spain, most of continental Europe still runs on this model. And it worked beautifully when there were roughly 12 workers for every retiree globally in 1950. Today, that ratio is collapsing toward 4 to 1 by 2050. Germany's pension contribution rate is already set to rise from 18.6% to 22.3% of gross salary by 2045. France spends 14.7% of its entire GDP on pensions, 2.5 points above the EU average. A German nurse today pays 18.6% of every paycheck into this system, and the math guarantees she will never see the return her parents got. Model 2. Beveridge, 1942, United Kingdom. The state basic pension. William Beveridge designed a flat-rate floor to prevent destitution, explicitly not to maintain living standards. But here's what most people don't know. The UK state pension was set below subsistence level from day one in 1948. It never fulfilled Beveridge's own promise. Today, the full state pension pays roughly £8,700 per year against approximately $13,200 in basic expenditure needs. That's a £4,500 annual shortfall. A retired British shopkeeper today lives in the gap between what Beveridge promised and what the Treasury delivered. 80 years of underfunding dressed up as tradition. Model 3. Chile, 1981. Private individual accounts. José Piñera, Pinochet's labor minister and one of Milton Friedman's Chicago boys, designed a system where every worker puts a mandatory 10% of salary into private accounts managed by for-profit companies. The pitch was 70 to 80% replacement rates. The World Bank endorsed it in its landmark 1994 report, Averting the Old Age Crisis. 33 countries copied it. The result? 17%. A retired Chilean teacher today collects roughly 1/6 of what she earned from a system the entire world was told to emulate. Now, every one of these models was designed for a world that looked nothing like today. When US Social Security launched in 1935, life expectancy at birth was roughly 61. Retirement was set at 65. Only 7% of Americans were over 65, with about 37 workers per beneficiary. Today, life expectancy is around 79. 17% of the population is over 65, and there are fewer than 3 workers per beneficiary. When Bismarck set the retirement age at 70 in 1889, it exceeded average life expectancy. Most workers were never supposed to collect. The fertility collapse sealed it. Global fertility has more than halved, from roughly 5 children per woman in the 1960s to 2.3 today. 110 of 204 countries are now below replacement level. South Korea sits at 0.82, the lowest on Earth. And the shift from collective to individual risk was deliberate. In the 1970s, over 60% of US private sector workers had a defined benefit pension. By the 2020s, fewer than 1 in 8. The risk moved from the employer's balance sheet to your brokerage account, and nobody asked you. 3 models, 3 different designs, 3 different eras, all failing. But demographics is the headline everyone already knows. What most people don't realize is that after 2008, central banks detonated a second bomb inside pension math, one that made everything exponentially worse. After 2008, central banks printed $28 trillion in new money through quantitative easing. The Federal Reserve's balance sheet went from 0.9 trillion to 9 trillion, a tenfold expansion. This crushed bond yields to zero, and in some cases negative. At the peak in December 2020, $18 trillion in bonds worldwide paid negative interest. Investors were literally paying governments for the privilege of lending them money. Here's the math that matters. The same pension obligation that cost $258 million to fund at 7% interest now costs $673 million at 2%. That's 2.6 times more expensive. Think of it this way. Imagine you need to save enough to generate $1 million in retirement income. At 7% returns, you need about $14 million in the bank. At 2%, you need $50 million. Same retirement, 3.5 times more money. That's what central banks did to every pension fund on the planet, overnight. Central banks didn't just lower interest rates, they tripled the cost of retirement, and no one voted for it. So what happens when you combine collapsing demographics with collapsing interest rates? You get the pension disasters that already happened, and barely anyone noticed. The world's largest pension fund, roughly $1.87 trillion, or 293.5 trillion yen, made a desperate bet. In October 2014, Prime Minister Shinzo Abe forced GPIF to slash safe government bonds from 67% of the portfolio to 25%. Equity exposure doubled to 50%. The goal wasn't retirement security, it was propping up stock markets under Abenomics. The result? 7.88 trillion yen, roughly $64 billion, lost in a single quarter, the worst quarterly loss in GPIF's history. Then came the 20 million yen scandal. In June 2019, Japan's Financial Services Agency concluded that retirees need 20 million yen in personal savings beyond their pension. That's roughly $130,000. Finance Minister Taro Aso refused to accept the report, called it a misunderstanding. With post-2019 inflation, analysts now estimate it's a 40 million yen problem. Japan's pension replacement rate sits at roughly 32 to 40%, among the lowest in the OECD. The gender pension gap is 47%, worst among developed nations. And the rise of old age bankruptcy, elderly Japanese forced to declare insolvency as pensions and savings simply fail to cover living expenses. Japan uses something called a macroeconomic slide. It automatically reduces benefits as demographics worsen. No dramatic depletion date, no headline-grabbing crash, just a slow, continuous erosion of purchasing power over roughly 100 years. So Japan's solution to the pension crisis was to put the world's largest pension fund into the stock market casino. Cumulative returns since 2001, 196.4 trillion yen. The gamble worked, so far, but individual quarters can still lose 9 trillion. That's the thing about casinos. The house always wins eventually. Now let's talk about the country that invented creative accounting, unfunded liabilities. Somewhere between $1.3 and $1.6 trillion, using the official discount rates of around 6.8%, or roughly 5 trillion using Treasury yields of 2.1%, according to Stanford economist Joshua Rao. The difference between those two numbers is the biggest accounting trick in American public finance. Pension systems get to pick their own discount rate. That's like letting a student grade their own exam. Illinois is the worst funded state in the nation at roughly 51%, carrying over $200 billion in unfunded liabilities. Its pension debt grew by $1.5 billion in 2024, even during a good return year. Do the math. If your debt grows in a good year, what happens in a bad one? And it's not just Illinois. New Jersey. 6 out of 7 state pension funds projected insolvent by 2027. CalPERS. $556 billion, the largest U.S. public pension, has watched employer contributions rise from 9.4% of payroll in 2001 to 31.7% in 2025. In 1999, California's SB 400 law retroactively expanded benefits by roughly 50% based on CalPERS' assurance that excess returns would cover the cost. They didn't. The most underfunded individual funds. California JRF at 1.8% funded. Chicago Police at 26.5%. Detroit, July 18, 2013. The largest municipal bankruptcy in American history. $18 to $20 billion in debt, roughly 60% tied to pension and retiree healthcare obligations. The Detroit Institute of Arts collection, Van Gogh, Rembrandt, was nearly liquidated to pay retirees. Let that sink in. A city almost sold its Van Goghs to cover pension checks. Instead, $816 million was raised from foundations in what they called the Grand Bargain. Civilian retirees still took a 4.5% cut and lost all cost of living adjustments. Here's the number that should make you angry. 54% of all pension contributions in 2024 went to paying down past debt, not funding new benefits. Workers today are literally paying for promises made to the previous generation. If you've ever looked at your retirement statement and thought this can't be right, it probably isn't. But at least in America, the crisis is slow-moving. In the United Kingdom, it almost happened overnight. September 23, 2022. Chancellor Kwasi Kwarteng announces £45 billion per year in unfunded tax cuts with no independent forecast. Sterling crashes to an all-time low of $1.03. 30-year gilt yields spike 130 to 140 basis points in 3 days, more than twice the largest comparable move since 2000. Then, £1.5 trillion in LDI strategies unraveled. LDI, liability-driven investment, is essentially pension funds using borrowed money to bet on government bonds. They'd leveraged up 2.7 times. When bond prices crashed, margin calls hit £70 billion. The big three, LGIM, Insight Investment, and BlackRock, controlled 85 to 87% of UK LDI assets. They'd sold these leveraged strategies as standard, safe practice for years. The night of September 27th, LDI fund managers warned the Bank of England that multiple funds would fall to negative net asset value by morning. Deputy Governor John Cunliffe confirmed it. Bank of England staff worked through the night. On September 28th, the bank committed £65 billion in emergency gilt purchases. Liz Truss resigned after 44 days, the shortest-serving Prime Minister in UK history. Kwarteng was fired after 38. Now here's the paradox most people miss. Most pension funds' funding ratios actually improved, because higher yields reduced liabilities more than assets fell. The aggregate surplus tripled from £57 billion to £204 billion over 2022. But 93% of schemes saw real asset losses. Over half lost 20 to 40% of assets. Academic researchers Ian Clasher and Con Keating estimated gross losses of £500 billion in parliamentary testimony. Clasher stated, quote, "This is not a paper loss. This is a real loss." End quote. The same event that nearly destroyed the system also technically rescued it. Let that sink in. So that's the disasters. But here's where it gets really interesting, because some countries saw all of this coming. They redesigned their systems from scratch, and they created entirely new traps. Now, you might think some countries got it right. Australia built a $4.5 trillion superannuation system, fourth largest pension pool on Earth. Singapore mandated workers save 37% of wages. Home ownership hit 90%. The Netherlands was literally ranked number 1 in the world, year after year. Surely one of them cracked the code. None of them did. Australia's tax concessions are a wealth transfer to the rich. Singapore's workers poured their retirement savings into housing they can't eat. And the Netherlands, the number 1 system, converted €500 billion in guaranteed pensions to market-dependent accounts, with the opt-out amendment defeated by a single parliamentary vote, 72 to 73. If you have a 401k, a superannuation account, or any retirement savings at all, this next section is the one that should worry you most. Because fixing pensions in one way broke something else, every single time. This is what economists call a structural trap, and it's the reason your pension is in more danger than you think. Chile's private pension administrators, the AFPs, charged 1.71% of earnings in fees. Sounds small. Over a 40-year career, it's devastating. Eliminating the fixed fee alone would have increased pensions by 15 to 20%. The AFP companies scored 14th out of 15 countries on global transparency benchmarks. This wasn't a market failure. This was a market working exactly as designed, extracting maximum value from a captive customer base with no choice but to participate. When COVID hit, the Chilean Congress allowed 3 rounds of emergency withdrawals. Roughly $50 billion was extracted, approximately 20% of GDP. 4 million workers, 39% of all account holders, completely emptied their accounts to zero. Every dollar withdrawn destroys $1.59 in future retirement savings when you account for lost compound growth. The impact will affect cohorts retiring through 2050. The breaking point came in 2019. 1.2 million people marched in Santiago, the largest protests in Chilean history. The slogan, "It's not 30 pesos, it's 30 years." Pensions were the #1 issue. President Gabriel Boric's 2025 reform finally introduced employer contributions, 1% rising to 8.5% by 2035, and a public fund called FAPP. The country that invented private pensions had to admit the private model alone failed. Central banks didn't just crush bond yields. They forced every pension fund on Earth into riskier assets to chase the returns they needed to stay solvent. CalPERS increased its private equity target to 17%, added leverage up to 5 times, and created private debt as an entirely new asset class. Across US public pensions, alternatives now account for 31.7% of investments, near zero a few decades ago. And here's the unsettling part: 27.7% of all pension assets now rely on non-public valuation methods. Nobody really knows what they're worth until someone tries to sell them. Think about that for a second. Almost a third of all pension money is now invested in things nobody can independently price. When the next crisis hits, we won't know what these assets are worth until it's too late. UK pension funds adopted leveraged LDI, £1.5 trillion in strategies sold as safe by BlackRock, LGIM, and Insight. It nearly destroyed the gilt market. Post-crisis, the LDI market has halved to roughly $700 billion. GPIF went from 67% bonds to 25%. The world's largest pension fund now has half its money in equities. The pattern is the same everywhere. Pension funds that used to buy government bonds and clip coupons are now running leveraged hedge fund strategies because they have no choice. The Netherlands had everything: €1.5 trillion in assets, 90% coverage, the #1 global ranking. Its funding ratio peaked at roughly 230% in 1990. It still broke. The mechanism was interest rates. The Dutch central bank required liabilities to be discounted at risk-free rates. When the ECB pushed its deposit rate to negative 0.50%, liabilities exploded on paper. Funding ratios crashed from 230% in 1990 to 95% in 2020. Funds couldn't index pensions to inflation for over a decade. Retirees with supplementary pensions above €3,000 per month saw purchasing power fall by almost 11% between 2011 and 2022. In 2013, 66 funds cut nominal benefits, cuts of 0.5 to 7%. The fix was to convert to defined contribution. The new system explicitly drops guaranteed benefits. Pensions are now expectations, not promises. Market crashes will directly reduce payouts. And in a detail that should surprise no one, politicians' pensions were not included in the reform. Pensions Minister Carola Schouten confirmed during Senate debates they'd be dealt with in separate legislation. As of 2026, this has not been resolved. Sound familiar? Chile's military exempted themselves from the system they created. Dutch politicians exempted themselves from the reform they imposed. Different continent, different century, same playbook. At this point you might be thinking, surely someone got it right. Australia? Singapore? They designed their systems from scratch with decades of hindsight. Spoiler, they didn't. But the ways they failed are fascinating. Australia built a $4.5 trillion superannuation system and then undermined it with tax policy. Superannuation tax concessions cost 51.7 billion Australian dollars per year, nearly as much as the age pension itself at 58.9 billion. But 34% of those concessions go to the richest 10%. More than half of single retirees who rent privately live in poverty. A man in the lowest socio-economic group lives 11.5 years less than a man in the highest, meaning the poor subsidize the rich's longer retirements. The system is becoming what critics call a taxpayer-subsidized inheritance scheme. Singapore mandated a 37% contribution rate and earned an A grade in the 2025 Mercer Index, score 80.8. On paper, the world's most disciplined savings system. In practice, 44% of all cumulative CPF contributions were consumed by housing, not retirement. Only 29% remains in accounts for actual retirement savings. By 2030, nearly half of public housing flats will be over 50 years old. These are 99-year leases that depreciate. Singaporeans are asset-rich in depreciating property and cash-poor for retirement. You don't need a PhD in economics to see the pattern. Pay-as-you-go systems break when workers per retiree falls below roughly 3-to-1, now happening everywhere. Funded and private systems break when returns can't beat the combination of fees, inflation, and longevity. Central bank intervention breaks the math for all systems simultaneously, and reforming from one model to another just moves the risk. From government to individual in the Netherlands, from collective to market in Chile, from cash to illiquid property in Singapore. Every door leads to a different trap. So if every model fails, if every reform creates a new trap, what's actually coming? The World Economic Forum's 2017 projection, the global pension gap grows to $400 trillion by 2050, roughly 5 times the current global economy, growing at $28 billion per day. For the US alone, $28 trillion by 2050. The US accounts for roughly 33% of the gap, China 30%, India 20%. That $400 trillion figure hasn't been formally revised since 2017, but it was reaffirmed at Davos in January 2025. And given that demographics have deteriorated faster than projected, Japan's births running 15 years ahead of worst case, South Korea's fertility at 0.82, the actual gap is likely larger. Now here's the part that makes this irreversible. Even if fertility returned to replacement level tomorrow, the OECD confirms it would have, quote, negligible impact on GDP per capita by 2060, because new cohorts take 20 to 25 years to enter the workforce. The demographic die is cast. By 2050, 5 OECD countries, Italy, Japan, Poland, Spain, and South Korea, will have old age dependency ratios above 75%, roughly 3 retirees for every 4 workers. South Korea's dependency ratio is projected to exceed 100 by 2100, more dependents than workers. Its national pension fund peaks at roughly 1,972 trillion won in 2039 and is projected to be fully depleted by 2055. US Social Security trustees project income will cover only 79% of scheduled benefits by 2035. Germany's pension reserves, roughly 1% of GDP, are expected to be exhausted by 2028. But here's the revelation that ties everything together. The global pension system has been transformed. It is no longer primarily a retirement security system. It has become a $68 trillion pool of capital for the financial industry to manage, extract fees from, and use to fuel market speculation. The shift from defined benefit to defined contribution was the largest, quietest transfer of risk in modern history. The financial industry privatized the gains through fees and asset management, and socialized the losses. Market crashes are your problem now. And now the answer to the question we started with. The military junta that designed Chile's private pensions exempted themselves for a reason. They knew the math. The World Bank that endorsed it has since acknowledged the model has challenges. And the $65 trillion gap? That was the optimistic estimate from 2017. The military junta knew, the central bankers knew, the politicians who exempted themselves knew. The question isn't whether the pension promise will break, it's what happens to the 3 billion people counting on it. So what happens now? 3 scenarios, none of them good. The slow squeeze. This is the most likely. Governments gradually raise retirement ages, cut replacement rates, increase contributions. No single crisis, just erosion. Germany is already planning 22.3% contribution rates by 2045. Japan's macroeconomic slide automatically reduces benefits every year. The Netherlands dropped guarantees entirely. The pension promise doesn't break, it shrinks until it means nothing. The market shock. This one's periodic and inevitable. Another LDI-style crisis. US public pensions stress-tested. A 20% market downturn pushes average funded ratios to roughly 63% and unfunded liabilities to $2.74 trillion. New Jersey has 6 out of 7 funds projected insolvent by 2027. The question isn't if another shock hits, but which state or country breaks first. The generational renegotiation. This is already happening. The Netherlands reform is the template. Convert guarantees to expectations. Shift risk from institutions to individuals. As one insurance CEO warned, quote, "We will undoubtedly witness a reduction in private pensions, which will bear more heavily on people between 30 and 50, end quote. The generation that built these systems will be the last to benefit from them. Who wins? Those who diversified beyond pension promises early. Countries with sovereign wealth funds as backstops, Norway, Singapore. And of course, the financial industry that manages the $68 trillion asset pool. Who loses? Workers between 30 and 55 in pay-as-you-go systems who are paying for current retirees but won't receive equivalent benefits. Public sector employees in underfunded US states. Anyone whose entire retirement depends on a single system. Somewhere in Santiago, a retired teacher collects 17% of what she earned. In Tokyo, an elderly man works a convenience store because his pension can't cover rent. In Detroit, a firefighter's pension was cut to save a Van Gogh. The $65 trillion gap isn't a number, it's their lives, and it will be yours. The pension system you're paying into was designed for a world with 5 children per family, life expectancy of 65, and bond yields of 6%. None of those things exist anymore. The $65 trillion gap isn't an abstraction. It's the difference between the retirement you were promised and the retirement you'll actually get. No government will tell you this on a billboard. You just watched a 33-minute video about it. And if you haven't seen our deep dive into Iran's sanctions economy, how the longest economic siege in modern history created a parallel financial system, check it out. Links on screen. Now I want to hear from you. Drop your prediction in the comments. Will your country's pension system survive the next 20 years intact, or are we heading for a generational renegotiation? Let me know below. What can you actually do about it? That's a question worth its own deep dive, and it's coming. If you're not subscribed, now's the time.